Welcome to our quarterly investment feedback. Given it's the end of the year, we will be reflecting on the year as a whole. And as we record in mid-December, we can say that 2021 was a good year for returns despite tremendous uncertainty. This year has shown that sticking to one's plan in conjunction with your planner is rewarded over time. The strategies have done well in absolute terms and shown material improvement against the inflation targets over their minimum investment period. And this is because we've also stuck to our plan, which is ultimately the philosophy and the process that we employ in managing the funds. Today, we're going to talk to the performance of the growth asset classes that have driven performance of the strategies in 2021. So let's start with SA equity. The local market has recovered strongly despite South Africa still struggling with economic growth, high employment, and socioeconomic problems. So Michael, why has the SA market performed so well, and how have our managers performed in this context?
Yeah, thanks, Monene. I think it's a timely reminder that the South African economy and the South African equity market are not the same thing. So over time, the makeup of our local market has shifted quite a bit to the point where now the fortunes of our local market aren't really tied to the fortunes of the local economy. I mean, there are obviously going to be a few companies where the low growth environment locally impacts them more than others, but our market now has a large component of companies that generate their earnings offshore. That commonly gets called the Rand hedge component of our market. It comprises companies such as the miners, whose fortunes are tied to the underlying commodity prices that they mine. Naspers and Prosus, which are essentially Chinese internet companies, where their share price movements and their fortunes are largely driven by the Chinese internet giant Tencent. And we've also got a lot of large global industrial companies such as Richemont, British American Tobacco, and Anheuser-Busch that are large companies that just happen to be listed here. So our local equity market has done, as you say, has done very well this year. I do want to timestamp this though, just so that we're not tempting fate, because we are recording this in the middle of December. But our market has so far delivered around 20 to 25% returns for the year. And that is despite the fact that the local economy itself, while having a better 2021 than it did 2020, has still got the very significant challenges that all of us that live here are well aware of. I think what's been interesting in our market this year is that you've seen a number of different stories playing out. And generally the returns in our market have come from a variety of different sources. So we've had a bit of a recovery story playing out in the SA Inc. Component of our market, where some of the financials companies, such as the banks and the property companies, have done quite well. We've seen strength in some of the resources companies, in particular some of the diversified miners, such as Glencore and Anglo American, as well as Sasol, which has also been a bit of a recovery story as you know the oil price has risen. And then in industrials generally, they've done quite well with some standout share performances from the likes of MTN, Aspen, and Richemont, who've all done very well. But I think what is interesting to note in all of this is that it's been delivered in a period where our market heavyweights, Naspers and Prosus, that have driven South African equity market returns for so long, are actually having a relatively poor year, with those two counters being down somewhere in the region of 20%. So it's been a good year for South African equities. And on top of that, which has added a lot of value to our fund returns, it's also been a very good year for the combination of South African equity managers that we have, who've also done really well. Our combination of managers is ahead of the benchmark somewhere by around 6 to 7% for the year so far. So it's been a good year to date, and that follows on the back of what was a very good 2020 from an outperformance perspective as well. So the net effect of that is that it's lifted the longer term performance of the South African equity building block, where we are now ahead of the benchmark net of manager fees, and that's important as well, over all time periods going out to 15 years. And I think that illustrates two things to me. The first is that selecting and having the right active managers can have a lot of can add a lot of value in our clients' lives. And the second is that having patience in those managers when they are underperforming is so important, because particularly when those are good managers who are just going through what would be a typical short-term underperformance cycle, which happens with all managers. And it's something that we experienced a few years back, and our patience has been rewarded, given what our combination of managers have delivered for our clients.
Thank you, Michael. And it's a reminder not to fixate on the short term and all the risks that one can see at times, because then you miss the opportunity. And I think that's a key question for people on the call today. Is what are the prospects for SA equity going forward?
Yeah, I mean, we'd obviously all have a crystal ball to be able to know the future. And particularly in the backdrop, or against the backdrop of a low economic growth environment locally. So, I mean, if we look at the SA Inc. component of our market, whose fortunes are most closely linked to the South African economy, longer term, if South African growth remains challenged and the South African consumer remains under pressure, that obviously doesn't bode well for those companies' longer term prospects. However, what we've seen throughout the pandemic is that those South African companies who've been able to manage their costs and manage their balance sheets well have been able to come out on the other side well positioned to deliver earnings growth and grow their market share as things have recovered. And the pandemic highlights that, you know, there've been winners and losers in markets as all of the dislocation has happened. And as one of our managers has observed, we're starting to see that play out in certain market sectors as well, where the strong are getting stronger and taking market share, and the gap between the winners and the losers in certain industries is widening. So it may not necessarily be all doom and gloom for the local companies, but you know, these things are difficult to forecast, and even with perfect foresight on the macro environment, which nobody has, it may not necessarily play out the way that you expect. And I think that our market probably has two things going for it against the backdrop of low local economic growth. And the first, as I've already mentioned, is that our market isn't a good proxy for the local economy, and that there are a number of companies listed here whose fortunes aren't tied to South Africa. And I think the second is that the valuations on offer in our market at the moment are still fairly attractive. And that's even with the recent recovery that we've seen. And with a good level of valuation, that should provide investors with something of a cushion and a margin of safety.
Thanks, Michael. And that takes us on to property, because as much as there were surprises within the SA equity market, I think many people are surprised at the strong recovery that we've seen within the SA property sector. So Busi, if we look at SA property in South Africa, it's dominated by retail and office, both of which have been hurt by lockdowns and work from home. So why the very strong recovery we've seen, and what are the prospects going forward?
Certainly, Monene, it's definitely astounding how well the sector has done, especially given the challenges that the sector faced even before COVID. Now, if you add COVID to the mix, it's really not surprising why investors were so pessimistic about the sector, to the extent that we saw the index sell off north of 50% between Jan and October in 2020. However, what none of us saw coming was the vaccine announcement that came out in November, which saw global markets really quite strongly. And alongside those markets was the local listed space. And we saw this continue, this really continue into 2021. And this was largely supported by the thriving mining as well as agricultural sectors locally, which really supported spending. Also, if we just look at the COVID-related government grants that were extended, to the broader population. And what also came as a big surprise was the speed at which these companies managed to pay down their debt. And as such, as things stand now, the average debt in the sector is sitting well below 40%, which is, the broadly acceptable level. And so while the sector is up 70% from the October lows in 2020, it is still 10% below pre-COVID levels. And this is given the weak economic fundamentals that continue to persist in the sector, including high levels of vacancies, which continue to trend upwards, and also that playing out in rental reversions that are currently sitting at almost record levels. And so while the sector has really done well, we remain quite concerned about the underlying fundamentals and the outlook going forward.
Busi, thank you very much for that insight, which takes us on to another part of global, which is global equity. Craig, the market was expensive when we started the year, but it has continued to perform very, very well. What has been behind this very strong outcome for global equity this year?
Yes, thank you, Monene. Global equity has, as you say, given us very strong absolute performance, up 10% in US dollars, up 19% in rands. The difference between the rand and the dollar performance shows the US dollar strength versus the rand. Something that we've seen globally, with the US dollar strengthened versus most major currencies around the world. It's largely because of the fact that the US economy and companies continue to do well. The key drivers there is that the US market has beaten earnings expectations every quarter this year. For example, we had earnings expectation growth of 28%. The market delivered 39%, so significantly above expectations. We've seen the US market deliver 27% returns year to date. But another interesting way to look at it is from a global sector perspective. Here, returns have been much more broad-based. So, for example, the largest sector return is energy, up 43%. That's on the back of the high oil price. The second sector is tech, up 30%. That's on the back of earnings beats. The third sector is financials, up 23%. And that's on a different interest rate outlook. So it's important to highlight the fact that returns have been incredibly diversified. It's great to see the performance given the diverse return profile.
Thank you, Craig. As you say, the market has been supported by earnings growth this year. So very strong performance, but also very strong earnings growth. What is the prospects for global equity going forward from an earnings perspective? And I suppose, how does that tie back to valuation? There is a perception that global equity is very expensive, though that, as we know, is mainly due to the rating on the US market. But yeah, what are the prospects for going forward?
Yes, you're correct, Monene. So we see opportunity outside of the US. Take, for example, Europe, which is up 22% year to date, quite close to the US return. The interesting difference here is that the US is objectively expensive, as you point out. So it's expensive both relative to other countries, as well as relative to its own history, currently trading at 21 times forward earnings. So if we contrast that to European valuations, which have come down to much more reasonable levels, currently trading at 14.3 times earnings. There's a significant difference between valuation, and our portfolio is positioned to benefit from that. So we underweight the US and we are overweight the rest of the world. I think with any of these conversations, we always get asked about risks, whether it be inflation, Fed policy, Chinese regulation. And yeah, it's important to remember that risks are ever present. We stick to our process, which means we're actively researching to ensure that we can monitor for risks and for opportunities as well. We construct resilient portfolios. So, for example, our building block performance did really well, despite the fact that we had exposure to Chinese regulatory risk. And the final thing that we do is that we have a deep understanding of managers, and that is important to give us the conviction that we need to stick with managers through volatility. An example here would be Harris, who are our value manager that underperformed in 2020, but we saw that they were one of the largest contributors to outperformance this last year. I think overall it's great to see that global equity process continues to deliver returns despite what has been quite a bumpy year, where returns have come from a variety of different sectors.
Thank you, Craig. Global equity is a complex asset class. We have investments in different regions across very varied sectors. And as you've said, the valuation in the regions and the sectors also differ. So on balance, we still think there's a lot of opportunity within global equity, and we believe that our managers can capture that in portfolios for us. So we've had a very strong outcome from growth assets over the last year. But many people are already looking forward and asking, what about the year ahead? We can't forecast the future, so try not to fixate on predicting the outcomes of each. We try to understand the risk and the opportunity and position our portfolios for the most robust outcomes in trying to achieve the strategy objectives. So if we look locally, the list of problems is long, but 2021 has shown that asset classes can deliver despite the environment we find ourselves in. South Africa still benefits from relatively elevated commodity prices, which supported companies, their workers, and provided additional income to the fiscus over the last 2 years. As Michael has spoken to, company management has used this crisis to right-size their businesses and on average are generating very good profits. The government is committed to fiscal sustainability. We all know this is a challenge with rising unemployment, but so far that commitment is there. Implementation of economic reforms remains slow and will only yield benefits over time. So the country needs faster economic growth and job creation. But we don't position the portfolios in the hope of this happening. We look at the opportunity and the risk and create a balance from those two. Globally, economic growth remains strong, and this is positive for investors going forward. The key risk is inflation, which is our main concern in terms of local and global assets. Inflation is a product of the pandemic and supply chain disruptions, but it's proving to be stickier than expected. So the key risk is how central banks respond to this risk and how quickly they raise interest rates, and this could ultimately hurt markets. So we're keeping a key focus on this. COVID also remains a wily and unpredictable foe. So in closing, we are still positive on growth assets, but given the strong returns we've seen over the past year, we've taken some profits in these asset classes and reinvested them into income generating assets locally. So thank you very much for your time today and wishing you all the very best for 2022.